We estimate around 90% of investors are simply unaware of the full extent of the negative impact that a multitude of factors generally referred to as costs can have on their investment returns. So today we'll break down these costs, who it is that benefits from eating away into your returns, and most importantly, how to try to mitigate them. Now, what do we mean when we refer to costs? Buffett refers to these friction costs, or the percentage of your investment returns raked off by an army of little helpers. These are the people who make a living by helping ordinary savers and investors. Well, in no particular order, let's list a few of these helpers. Certified financial planners, independent financial advisors, brokers, dealers, asset allocators, analysts, strategists, mutual fund managers, private equity advisors, hedge fund managers, and the list goes on and on. In addition, governments will take their share through various transaction and capital gains taxes, which are about the only fees we'd recommend you pay in full on this list. This all makes sense when you start thinking about who it is that pays for outrageous Wall Street salaries, the plush offices, the fat expense accounts, fabulous holiday homes, the Porsches and the yachts and the Rolex watches. The answer's simple. You do. You pay for them in unjustifiable management fees, you pay for them in annual fees, transaction costs, administrative costs. This entire industry chipping away itty-bitty percentages for themselves, based around the absurd and unnecessary costs of high-frequency trading, hedge fund fees, performance fees. Of course, all investors require functioning and reliable capital markets. There are certainly a number of basic systems and services which have to be paid for. However, the underlying costs of providing these services are modest, especially compared to the myriad of unnecessary provisions offered by a comically bloated financial services industry. Now for an example of who benefits from all of this. We were recently reviewing the accounts of a closed-end investment fund specialising in small UK companies. Total income of the fund was £2.2 million, mostly dividend income, while the total costs were £2.7 million, mostly in management fee. In other words, precisely none of the dividends flowed into the investors' pockets, and instead they flowed into the investment managers' pockets. And more broadly, there's a famous example in the investment world. In 2007, Warren Buffett made a $1 million bet against hedge fund managers, challenging them to select a portfolio of hedge funds that could outperform a simple S&P 500 index over a 10-year period. The bet was accepted by Ted Sides, a hedge fund manager from Protege Partners, who chose 5 hedge funds of funds to represent the active management side of the bet. By the end of 2017, Buffett's passive investment strategy had significantly outperformed the hedge funds, with the S&P 500 index fund achieving a total gain of 125.8%, compared to gains ranging from 2.8 to 87.8% for the hedge funds. The argument of these fund managers is that they'll win because they can pick the best 25 companies, or the best foreign currency plays, or the best sectors, but the evidence suggests that this is not necessarily within the capability of many of them. At this point, we'd like to stress it is doable, but it is hard. Additionally, and this is the big thing here, the management charges effectively leached money out of the funds. Even if they had beaten the index in gross returns, the net wasn't even close. So Buffett won the bet easily. And yet there's still a huge industry of funds run by people paying themselves very handsomely. Most egregious of all, the hedge funds charging a 2% base fee with a further 20% on any profits. Amusingly, this 20% is not paid back when they make losses. Okay, so now you have an idea of what these costs are and who it is that's getting paid by them. How do we actually go about mitigating them? Well, the mantra of all good long-term investors centers around compounding the dividends paid by and the earnings reinvested in good quality companies. You can either do this by investing in low-cost index funds, or, as we prefer, investing in a portfolio of the highest quality stocks while keeping costs to a minimum. One of the problems of many investors is that they overtrade. They expose themselves to far too many costs, so even if they do manage to select some of the absolute best stocks available, their costs will eat away at their profits hugely. And this is the biggest lesson we want you to take away from this video. If you can achieve one of these two portfolio types, it's really bad news for all these advisors who are trying to eat away at your profits, but it's great news for you. Now, we understand the world of finance and economics is not always simple. Beginner to moderately experienced investors should seek out some basic help on personal financial planning. Government-sponsored financial and pensions advice platforms can be a good place to start. In addition, we'd advise that you look for some guidance on basic tax planning. Finally, and I can't stress this one enough, find a low-cost, trustworthy investment platform to deal for you and hold your investment securely in their nominee account. We do emphasize low-cost index funds for the majority of investors as a good starting point. The S&P 500 has returned an impressive 10.5% per annum over 100 years, with dividends reinvested. Dividends account for about 40% of this total return. When adjusted for inflation, the return still comes out to a very respectable 7.4% per annum. Now, if you'd invested by giving your money to be managed instead of simply owning the index, that return goes down to near 5.5%. Still pretty good, but definitely not optimal. As we said before, we estimate the smart investor can reduce their cost burden from about 2% to near 0.2%, excluding the government's non-negotiable take, of course. This either via a hybrid fund of shares and stocks, as well as index funds, or as simply pure index funds. We also believe that there are some active fund managers who do add value at a reasonable cost. However, we're not in the business of promoting fund managers to our subscribers. There's a lovely irony that statistically the best active fund manager in history, Warren Buffett, has the lowest imaginable cost ratio via direct investment in Berkshire Hathaway. So returning to our original assertion that costs are this silent killer of investment returns, well, as you can see, costs clearly do matter. And the people who don't understand this are the ones generating their hard-earned money to the purchase of an underprivileged fund manager's third supercar. So what can you do about it? Find a low-cost investment platform, select some quality stocks, trade infrequently, reinvest your dividends into more quality stocks, and you'll do just fine. While it may feel less intimidating to just give your money to someone else, low costs inevitably result in higher returns. A 7% compound beats a 5% compound every time.
Okay, smartass, it can't be as easy as you seem to think to get these wonderful returns.
Well, first off, most people are looking for the instant gratification of money appearing out of nowhere via their stock doing that. 125% over 3 days looks so much sexier on TV, and it's a lot less sexy when it plummets by 250% in a few days' time. The reality is volatile stocks are the attractive options for day trader, for people wanting to make money quick, and the reality is that in the long term, it doesn't really usually work. The example of Buffett betting against hedge fund managers shows that overtrading and investing your money with the wrong people tends to yield lesser results than simply just having the market without any exposure to trying to select slightly better shares than the market average. Now in this video, we've outlined some of the basics on how to go about getting a decent return. But to learn the full depth of how we do this and how we beat that market return, we can only recommend that you do the most YouTubey of things and like and subscribe. Yeah, I hate YouTube sometimes. But seriously, we'll be going over all of these things in future videos, so if you are interested, and also if you enjoy the pitfalls and traps of the financial industry being exposed to you, please do keep watching, as we promise you, we're only scratching the surface. That's it for this video. Thank you very much for watching. I'll see you next time.